Unfortunately, due to all the changes with the tax code, the risks are increasing for you if you prepare your own tax return. What are the 5 biggest risks that you need to look out for if you prepare your own return? I've got that more coming up. If you think about it, it absolutely makes no sense that we still have to prepare our own tax returns. I mean, this is one of the things that really grinds my gears. So I can get on the soapbox here, but think about it. For 99% of us, the majority, if not all, of the tax documents that we receive, the information that goes onto our tax returns, comes on an official government form with our name and personal identifiable information, so our social security number, all that sort of stuff. It's all coming to us on those official forms, and it's also, a copy's also going to the IRS. So why do we then need to put all the numbers in the right boxes? The IRS is doing that already anyway. Certainly with technology these days, it's very clear. This form, if you got this form, this number goes in this area, and technology, the IRS should be computing our tax returns for us. It really is ridiculous that we actually have to prepare our returns. And I will be thankful, extremely thankful, for the day when it's all automated, whether that's in a couple of years or that's still a decade or more out. You know it's there, you know it's possible, and we'll be celebrating it when it happens. Until then, it seems like we're going backwards. It's getting more complicated to, 1, prepare your own return, and 2, to prepare it accurately. Part of this is due to just the unbelievable amount of tax law changes that we've seen over the past 5 years. It's almost laughable when you think about it. About a decade ago, politicians said, "Oh, you'll be able to prepare your taxes on a postcard." Oh my goodness, we are so far from that. From the Secure Act 1.0 that was passed into law with over 100 tax law changes, that happened before COVID. Then all the stimulus and tax law changes that happened during COVID. Then we've had the Inflation Reduction Act and some of these others. And then now, Secure Act 2.0. And then now with the new tax laws that were passed around July 4th of this year, there are so many new tax law changes. It's getting even more complicated, and I would argue risky, to do your tax return yourself or use technology to do your return. Again, at some point, it's just so obvious that we shouldn't have to prepare our own returns, that technology should do it for us. The IRS should just do it for us. But until then, you've got to watch out for these bigger risks if you're going to prepare your own return. The first is missing IRA contributions, Roth IRA contributions, 529 contributions, and HSA contributions. It's an increasing risk that if you prepare your own return, or you're not working with a certified financial planner to help quarterback all of this and make sure that you're getting your tax return accurate and all your tax planning done, that you're going to miss out on, if you made a contribution to one of those things, IRA, Roth IRA, HSA 529 plan, that it's not going to be reflected on your tax return. Why? What tax form? I mentioned that, we should be able to have our taxes automated, but it seems like we're getting further from that. What tax form reports your IRA contribution or your Roth IRA contribution? A tax form called the 5498. However, those tax forms are not being sent out until May. They used to, and I shared this on the Wise Money Show channel last year or earlier this year, that it used to be that if you made a contribution to one of those accounts during the calendar year, then you'd get a 5498 in January, at the end of January. But then if you also made a contribution, or if you then made a contribution in the spring, because you have up until April 15 to fund those, then you'll get another 5498 out there in May, and hopefully you captured the contribution on your taxes. Most companies are no longer doing that first step. Most companies are not issuing 5498s that first round. They're just doing them in May. And even if they did do a first round, but you made a contribution during from January 1 to April 15, you've got to make sure that you include that on your tax return. Otherwise, you're going to be missing out. Same thing with an HSA. An HSA, there's, you might say, well, I'm funding my HSA out of my paycheck and therefore it's reported on my W-2, right? Well, yes, and absolutely, that's fantastic and very easy. But if you're contributing to your HSA out of your pocket to fully max it out or get an extra deduction there, you might not have a tax form and you might then forget to make that contribution. And you might then forget to include that on your tax return. And then same with the 529 plan. There is no tax form that includes what you contributed to your 529 plan, to your state's 529 plan. Yeah, if you made a withdrawal, there is a tax form for that. But if you made a contribution, there is no tax form that reports it. I live in Indiana, where if you fund the Indiana 529 plan and you pay Indiana state taxes, you get a state tax credit on 20% of your contributions up to $7,500 in contribution. In Michigan, I'm right on the border of Indiana and Michigan. We've got a couple offices in Michigan. It's a deduction. But if you make those contributions and fail to report it on your tax return, then there's no benefit. And because of all the complexities with tax rules, missing out on funding a traditional IRA, Roth IRA, HSA or 529 plan, doing one of those things but forgetting to put it on your tax return is becoming more and more common. A second risk with doing your own tax return is incorrectly documenting a Roth conversion or backdoor Roth contributions. A backdoor Roth contribution is where you're contributing after-tax money into your IRA, but you're not deducting it, and then converting it, moving those dollars over to your Roth IRA. Should be really simple, right? However, this maneuver, typically a Roth conversion, that's a taxable event. You are shifting money from your pre-tax IRA over to your Roth. You've got to pay tax on it. Well, if you've contributed after-tax money to your IRA, you need to report that on a tax form called an 8606. Otherwise, if you don't, when you do that conversion, it's going to show up as taxable even though you didn't get the tax deduction. I recently did a video about some of those dangers. We saw a handful of them this past tax season where new folks came in and said, hey, we need some help with financial planning. It's multiple people, different people, where we then reviewed their prior tax returns before they were working with us, where they actually were doing the backdoor Roth and they were paying tax on the conversion, even though they never got a tax deduction on the contribution. They were paying double the tax to do this. And I think that's going to be a greater risk that happens the more with all the new tax law changes if you're filing your own return. Third, and we were just talking about this third risk and danger with preparing your own tax return is with some of the changes going on with the SALT cap change that we saw with these new tax laws. A lot of people that have put it on autopilot that, yeah, I'm just going to get the standard deduction are going to miss out on the opportunity to itemize. Now you might itemize because if you pay a lot of property taxes, pay a lot of state taxes, you might now then, because that cap is no longer $10,000, it's $40,000, as long as your income's below $500,000. That might mean you're going to itemize this year. But if you've just put it on autopilot that, yeah, I'm not going to include my property taxes, I'm not going to go through those motions here and fill all that out because I haven't been itemizing, you might significantly miss out on a tax benefit. But the other risk is there as well, that you might spend, if you're preparing your own return, a ton of time getting all your out-of-pocket medical expenses and gathering all your charitable donations and adding all that up when that itemized deduction really would only be this, and your standard, like you are miles away from a standard deduction. So just by preparing yourself, you might waste time doing one thing when you really don't need to, or you might say, I'm going to save time and just go simple and really miss out on a lot of deduction. And that flows right into the fourth danger. And this ties directly into just the unbelievable amount of tax law changes we've seen over the past 5 years, even just the past couple of years with Secure Act 2.0 and the new tax laws, and that is missing out on new deductions. Things like, we were just talking about this, which prompted the idea for the video to help you guys, and that is on our tax forms this year, our questionnaires for our clients, when we're asking them to share what's changed in their life so that we can prepare an accurate tax return. It's going to be asking about auto loans and auto loan interest. Did you buy a car this past year? Do you have an auto loan? What's the interest amount that you paid? And documenting all that to see, well, do you qualify for this new deduction? What about whether you have tips or not, right? Or what about some of these other deductions that are very, very obscure and baked into some of these new tax laws? You want to take advantage of them, but just going through the motions, doing your tax return yourself or doing it online likely is going to cause you to miss out on some of these new deductions that are available from these recent tax laws. And then finally, and I should have put this one first. This is where your certified financial planner comes in with coming up with creative solutions for you to pay the least amount of tax over your lifetime. That is the fifth danger for preparing your taxes by yourself, is missing out on tax planning opportunities. The goal of tax planning, which is one of the 6 areas of your financial life, is to look opportunistically at your tax picture, at your financial picture, to say, how can I pay the least amount of tax over my lifetime, if not multiple lifetimes? And when you're just preparing your return on your own or going through TurboTax or whatever it is, online calculator, and you're doing your own tax return, you don't know what you don't know. You might be missing some very, very clear opportunities, but without seeing it from that perspective, you might never take advantage of it. And I've tried to share a lot of them here on this channel, so make sure that you tune in, you subscribe, and turn on notifications so that you can catch these as well. But things like, well, you actually qualify for the retirement savers contribution credit, which is one of the best tax credits out there, but you didn't know. And therefore, you didn't contribute an extra couple $100 to your retirement account to fully optimize it. Another one did a video about recently where, well, we're funding our simple IRAs pre-tax, but you're actually not paying any taxes because there was never that creative kind of overview of, wait a second, here's your income, here are your deductions, here's your tax, but then here's your tax credits. With your 3 kids, they wipe out all your tax, you're getting this big refund. Oh, that means you actually shouldn't be contributing pre-tax at all. You need to be contributing Roth. What about if you're right on the threshold of having to pay income-related monthly adjustment amount, an IRMA for your Medicare, a surcharge for your Medicare Part B and Part D? That's the creative planning that you could miss out on opportunities if you're doing your return yourself. So how do you solve it? How do you address each of these big risks? And I mean, it seems like the risks and the challenges are increasing. Working with a certified financial planner. Your CFP should be doing comprehensive financial planning, looking at all 6 areas of your financial life. And like I said, tax planning is one of them. Not tax preparation, tax planning is one of them, but you want them helping to quarterback the tax preparation to ensure that you do capture opportunities to pay the least amount of tax over your lifetime, if not multiple lifetimes, and avoid tax surprises. Work with your CFP on that. If you don't have a CFP on your team, you can contact one on my team. Find us online, Korhorn.com. That's Korhorn with KWiseMoneyShow.com. You can find us there as well, or give us a call, 574-247-5898. All right, there you have it. Go out and take your next wise step in your financial life.